The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady. And, with what's all that's happening in our world, you might think, well, we can put taxes in the back burner, but stuff is happening. And, of course, you're going to get the best answer to all that stuff here at 9:30 a.m. WBEN. I'm Esther Gulius, the Tax Lady from EG Tax. And, of course, I'm joined in studio with Tiffany Fabian. Hey, Tiff.
Hey there, Esther. Happy Saturday.
Happy Saturday. And Christopher Fabian.
Hello, Esther.
Hello, Christopher. Okay, so first thing, before we get into the nitty-gritty, we want to talk about what's being proposed, because this stuff, if they can get their act together this week, this could come down this week. And, of course, once we have it all, once it's all finalized, we will let you know about what the tax increases are, because obviously to run these kind of budget deficits, they got to cover it somehow. And that's what the tax changes are about. And as soon as we know, we will let you know. But I'm going to give you the proposed changes so that if you're so inclined, you might want to call your state senator or representative and say, hey, what's going on?
And so,
right?
Esther, this is in the infrastructure bill, right?
It's tucked away in those 3 million pages, in the infrastructure bill.
And I got to just give a shout out. The Bills are slaying it right now. I know it's a preseason game, like 34-6.
What inning are we in?
A quarter.
Which quarter are we
in the third quarter.
So that's good.
Yeah, 36-6.
And I like that it's Chicago.
34-5, 6. Yes, me too.
Okay, so let's first talk about tax school. Tax school's coming up. We have our first session starting in September. Then we got a second one starting in October, right?
That's right.
Yep.
That's right.
It
Middle of September, meets 2 days a week or 2 evenings a week, and you're going to learn from A to Z, multiple locations, safe environment, so you can do a lot of learning. And what's our objective, Tiff?
Is that they come on board and work at one of our 32 offices. It's a great time. And as Esther always says, you'll be the hit at the parties, right?
At Christmas time.
Yeah.
You can say, oh, I know the answer to that.
And then
I
also
now understand how we get taxed. But did you know that we don't pay taxes? It's remarkable.
And then also our podcast. We've been doing our podcast, and those are a lot of fun. And so you can go to egtax.com.
Yeah, so we're kind of like teaching taxes on the podcast, which I think is remarkable. And by the way, you can go and download everything. But last week we talked about filing status and what's taxable income. And I know that sounds like a yawn, but believe me, when we talk about it, it is not a yawn.
Yeah, it's so funny. Our IT guy or his assistant can tell where they've been downloaded, and several people from Europe have been downloading the podcast. I don't know if they're really interested
Africa, Europe.
Yeah, interested in U.S. tax law or something of that nature, but it's a lot of fun.
You never know, right?
You never know.
Maybe the Taliban is looking for that, right? Because after all, I am a girl.
Yes.
Right?
Yes.
I'm Esther Gulius, the Tax Lady. 803-0930, 803-0930, star 930 on a cell phone. You can text us at 716-803-0930. And before we get into our subject matter, and you can call us about anything tax and financial related, because usually they tie together. We got some news. They're finally releasing those refunds on the unemployment.
Yeah.
And that's the good news.
That's the
What's
good news.
the bad news?
Oh, Chris, you were interviewed by Channel 7 yesterday. What did you have to say about the bad news?
You're going to say, is this really bad news after I say what it is? They're giving extra money.
Yeah, but it's going to be angst to get it squared away.
Oh, it's crazy. I mean, we're not talking a couple extra bucks, and we know they give interest with everything. We're talking $500 to $2,500 extra people are getting. And it's only going to be a matter of time before
They'll be asking for it back.
they're going to ask for it back, plus more interest than what
Right.
they gave you.
So if you've gotten a refund that you think is way too high, and by the way, you can call us and we'll run the numbers for you, but they have been sending out extra money and with no explanation. Now, in 2 or 3 weeks, you should get a letter from them explaining why the extra money, and that letter may say, please send it back. So you want to make sure that you don't go out and buy a new hot tub or something.
Right. Yeah, to recover from this humidity we're having right now.
Right.
Yeah, and they will ask for it back, and it's going to
Eventually they will. I think, and for those of you that people text me all the time and call me and say, I'm still waiting for my money. And so what we do is we let them in on the call that we make to the IRS. And the other day you called them, 22 times, Tiffany?
Yeah, well, that's what's so sad is I've been doing this for a long time, and the practitioner priority line used to get through like a hot knife in butter, but now you cannot get through. And so I feel like calling my congressman. I mean, it's just...
that wouldn't be a bad idea, Tiff. You're a taxpayer.
Yeah, it's so sad that I can't help my clients very easily like I used to.
And so we're as frustrated as you are. Maybe not as much as you, but because we do it all the time, our job is to help you. And when we can't get to the horse, we're trying to get to the horse's mouth. We want to talk to the horse's mouth, and they keep hanging up on us. It makes it really frustrating. But we're in there. We're in there trying.
Yep. And then the people also here, when we do finally get a hold of them, the IRS goes, I don't know.
That's right. Oh, your guess is as good as ours, right?
Yeah, I had a client, I did an amendment on the energy credit for them for 2019, and the money was seized from the IRS. He doesn't owe back child support. It's a married couple. They don't owe back IRS or New York. And so we called the IRS. We don't know why we seized your refund. It doesn't look like we should have. And so
So what'd you do, order a transcript?
I did a Form 911, although a transcript wouldn't be bad. But they looked
A transcript would at least say why they took the money. Because there must have been an outstanding balance, one would assume.
No, well, the IRS said there wasn't.
So I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930, and we have Rich hanging, right?
Yep.
Hey, Rich, how can we help you?
Okay, here's the question that I have, and you've done my taxes for the last numerous years. But when I was younger, I bought a bunch of Series E U.S. savings bonds, and they're now there's a whole group coming due. In other words, they've maxed out and
the income,
more
the interest
on
income,
and I have to sell them and then put them what have you. But what I was wondering is, how do I pay the taxes on them up front? In other words, because I understand if I wait until the end and pay it then, I can get charged for not having put the money in.
Right. So here's the thing. When you cash them in, the bank or financial institution that redeems them is going to send you a 1099 at the end of the year. Treasury, probably Treasury Direct, is going to send you a 1099 at the end of the year that says how much interest had accrued on those bonds. And at the time that you do your tax return, whatever your balance due is, that's what you'll pay. Now, you want to make sure that you have paid in at least the same amount this year as last year, even though you owe some money, because we can avoid a penalty for you.
Yeah,
right,
and
Chris?
and then don't forget it's tax-free on the state of New York.
Right.
And that's
so, just...
penalty.
Now, Tiff, you were just doing something the other day with changing paper bonds into e-bonds, right?
Yep. So there's a lot of listeners out there that have lots and lots and lots of paper bonds. And so in order to change the beneficiary, you have to turn them into e-bonds. So you go to U.S. Treasury Direct, and you open an account there, which is free of charge, and then you open up a conversion account, which is free of charge. You make an itinerary, a manifest, you print the manifest, and they become electronic, and it's very handy and important if you want to change the beneficiary, because they're just not dealing with the paper anymore.
Right.
Right. Now, Rich, you want to look at your page 2 of your 1040? and see what your total tax was last year before withholdings and estimates. And that's what you want to make sure you pay in this year to avoid the penalty you're talking about.
And if you need help with that, Rich, you can give us a call on Monday, and we'll walk you through the lines that you're supposed to be looking at. Oh, of course, you're our client, so
You can even give us a call
We
and-
can do that with you.
Yep.
Yeah, I'd appreciate that because I'm confused on this. Because,
Sure, we'll be very happy to help you. You know that.
Okay, what's the number?
632-7886.
7886.
Okay, Rich?
Hey, thank you very much.
Have a great weekend. Go Bills. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. We're going to take a short break, and we'll be back on the other side.
Got a message from you just the other day, saying it's over, let's go our separate ways. Said I asked too many questions, like where you been, and tell me, is that a sin when you're miles away?
Hey, I'm Esther Golias, the tax lady, and that's a recording done by Fatima Santini, who we met when we were on vacation last week. And so you should
She's
go to
very
her
talented.
website if you want to hear the whole recording. It's Fatima, or Fatima, or Fatima, I don't know. Fatima Negroy, Santini, and we told her we'd play the part of her recording, and she's, I would not say a starving artist, but she's somebody that's trying to break into the music business, right?
Very talented. Yeah.
Very talented lady.
Very well spoken and a very talented singer.
And we promised we'd play it, so we honored our promise, and she was a lovely lady, and we had a great time on vacation.
Oh,
Yes, we did.
Right?
it was amazing.
All right, so let's talk about, and again, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. Okay, so I think it's important for everybody to kind of get an idea what's in the proposed tax changes. We don't know that this is what's going to happen. Probably there'll be a modification of this, but important for you to know. First of all, for those of you that have C corporations, the tax rate now is a flat rate of 21%. They're proposing that be raised to 28%. So if your net profit on your C Corp is $10,000, right now you'll pay $2,100 in taxes on that. They would move it to $2,800. The question that I have is, if you have a C Corp, why aren't you an S Corp?
Yep.
Right?
Yeah, you make an election.
Because if you're in the 10% bracket, you'd pay $1,000 in taxes versus $2,800. That would save you $1,800. So if you're a C corporation and you'd like to investigate, especially now that they're talking, since it's a flat rate, since they're talking about moving the tax rate up, you should really, if you said, I didn't want to do this just seems so complicated to me, we can uncomplicate it, right?
Right. And not to mention, you talk about why being a C Corp, you also have the double taxation of a C Corp. So you
Absolutely.
have that profit, and then you say, well, that's my money. I'm writing myself a check, and it's tax-free. Well, it's not tax-free because it counts as dividends on your personal return.
So if this was a $10,000 net profit, then they would pay $2,100 right now in taxes, possibly 28 if the law changes. And if they took that $10,000 out and they're in the 10% tax bracket federal, then they wouldn't pay any tax because of the way the tax code is written right now. But potentially it could be 20% taxable when they get the dividends, right?
Right. Yep.
So if you're a C Corp, unless you're forced to be a C Corp, you really have to look at why you're a C Corp. Sometimes when it's first set up years ago, your accountant set it up not realizing or not knowing the benefits, or meant to opt you out, and they didn't. And all these years you've been paying double taxes. There is a way around it, and EG Tax will help you, right?
Definitely.
All right. I'm Esther Gillius, the tax lady, 8030930, 8030930, star 930 on a cell phone. Our text number is 716-8030930. Okay, then the top rate they're proposing is going to move from 37% to 39.6, with that kicker of the Medicare tax of 3.8%, which would mean that the top rate would go to 43% plus New York State.
Well, then also, aren't they also in this proposing the people who make over $400,000 in wages also have to start paying back into Medicare again through your paycheck?
Right, absolutely. If on your wages over. Well, and plus there's the Medicare. There's that Medicare 3.8%. I'm wondering if that's not magically baked into the cake. So I don't know for sure.
But we're talking, I mean, you're looking, it could easily be an extra 10% somebody's paying.
And so you're saying to somebody, gee, you're working hard. Thank God you've made it to the top. Now let's take half of your income.
Yep. And then New York State raised their tax brackets too for the higher.
And the other thing is, as these phase outs are happening, you want to make sure that you stay under these magic formulas in your family, and the only way to do that in most situations is to use your pension plan.
If you're self-employed, SEP.
Well, if you're self-employed, that's different. But if you're an employee, you know.
Use your.
So, okay, we have a text. What is it?
We do. We have a text. It says, if I am a corporation person, a S corp, and I have been for a few years, I have never filed. Do I have to? I don't think so, because I have no income. But my neighbor says I have to file. I'm so confused.
Oh well, I'm not talking about this. You guys, who wants to talk about this?
Per shareholder.
Well, the penalty for not filing is $195 a month per shareholder. So if you're the only shareholder for 3 years, you're looking at a pretty big penalty.
Right.
But what you may want to do, if there's no income and no expenses and you're not doing anything, you may want to file that initial return.
Make it your final.
Right, and make it your final return.
Right.
And if you decide to
close the corporation.
Close the corporation. Because if you're thinking about, well, maybe a couple years from now, the penalties for not filing are going to be way more expensive than starting up a new corporation.
Right. A lot of times people say, but I don't want to get rid of my corporation. It is not hard to start a corporation at all. You know, we do it all the time. If you want to do it yourself, you can go to bizfilings.com. It's not hard to start a corporation, but yes, you have to file a return.
So your neighbor was right.
Which I'm
in
very
this
surprised
instance.
is that New York State hasn't been writing them.
Yeah.
Yeah.
If it's a New York State corporation, I'm surprised they haven't been writing them. But yes, you do. And like Chris was saying, you have this ongoing penalty that you're going to get. And for the last few years, it's going to be a whole lot of money. If you have assets in the corporation, they can attach the assets. So I would suggest you give us a jingle on Monday so we can help unscrew the spaghetti.
And sometimes
so to speak.
the IRS will close the corporation all by itself too, right?
Yeah, after so many years, but
We could call and check.
yep.
Absolutely.
Right, and that's part if you can get a hold of them, right?
Yes.
Okay, going back to some of the proposed changes that they might be looking at this year, capital gains and qualified dividends with adjusted gross income, married filing joint over $1 million, you'll be taxed as ordinary income, and instead of using capital gains rate, over $500,000 if you're single. Appreciated gifts and transfers due to death. Remember, we've been talking about the stepped-up basis. Well, they're talking about eliminating the stepped-up basis, so that would be a really big thing. So if grandma or your mom or dad bought the house back 40 years ago for $20,000 and it's now worth $300,000 and you inherit it and you are in the right, if you're in a higher tax bracket, I don't even know, actually everything I read just made it sound like they were eliminating the stepped up basis altogether, and we won't know until they pass the law. But right now that is on the drawing board. That would cost you a lot of money.
Yeah, it most definitely. I mean, I know, just if you think about some people, you have these senior citizens, they bought a house back in the 60s for $50,000, $20,000, and now they're worth, because of the housing market, $200,000 to $250,000. Your kids could possibly, if they pass this, have a gain of $200,000 they have to pay tax on, where the old law, they would pay no tax.
But like you
so they're
started,
proposing that if you inherit something, an asset, that once you have that asset in your name from the donor, then it's considered a sale, like you were saying in Canada. It's like that, right, Chris?
Right. Anytime a name changes.
and I got to tell you.
And so then you end up paying the taxes up front, even though you didn't sell it.
You know, you started this whole conversation by saying there's such a large deficit and they have to find ways to solidify or seal the deal or fix the deficit. And this would really be and
this affects
gap.
This is not millionaire billionaires. This is just regular people, which is and that was what we had always said. Oh, don't worry about this. We'll get a stepped up basis. Oh, don't worry about that. You get a stepped up basis. Well, now it sounds like they're messing around with the basis. That's a big thing.
Right.
I'm Esther Gillius, the tax lady. 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. Now, estate tax increases. Right now, you don't pay any estate tax when you pass away until your assets exceed $11,007 million. And if you're married, your spouse would also get the $11,007 million. So it's well over $23 million. So suffice it to say, most people are not going to be paying estate taxes, right? Except maybe on the state of New York. They're proposing that be dropped to 3.5 million. So again, that, and you may say, oh, 3.5, I'll never come up to that, but you have to put into that all of your investments,
Why
all
don't
of
we
your
talk
assets,
about
your
this after
properties.
the news?
Pardon me?
Let's talk about this after the news.
Yeah, I got to take a break. I'm Esther Gillius, the tax lady. See you on the other side.
Do you have a text?
It was so good, it was so nice. Before you go, think it over twice. You never know how good it can be if you go on and leave.
All right, so again, that's our friend from vacation, Fatima Santini, who's leading us in after the break. And you can go to our website at Fatima Santini. She's a nice lady, and I promised that I would play her song.
And then we also heard that other wonderful lady in concert from Hawaii, too.
Oh, yeah, she was a Grammy
The
winner.
Grammy nominated.
6 times.
She was great.
The Hawaiian.
Great.
The stories.
So what
and
was her grandfather?
her mother and her grandmother.
But no, Walter Cronkite.
Not
right?
Walter Cronkite.
Not
Walter Windshield.
Walter Windshield.
Windshield.
And they kept saying Walter Windshield. I said it's not Walter Windshield, it's Walter Winchell. So, but it was very interesting. So anyway, all right, 8030930, 8030930, star 930 on a cell phone. Text us at 716-030-930. And by the way, if you hear something that is alarming to you, make sure you call your representative and state senator to express your concern, because and this is just the big stuff. Usually when they write the tax law, you find out that there's also a lot of other laws that are being changed that we aren't aware of, right? But we will talk about some of those proposed changes as well. We have another text here, Tiff, right?
Yep, it says if they pass the new law that you're talking about with capital gains, can they predate it to January of 2021?
I guess you can do anything, but I think right now, from what I hear, is that they're going to open that window of time. And so if we know that this is going to be effective on that whatever date that they make it effective, hopefully it would be January 1st, 2022, that would give us some time to move some assets around at a lower tax rate, because right now the maximum tax rate is 20%, and we're talking well over 40% if this whole thing passes. So a lot of people have made a lot of money in the market, and it's just downright scary. Obviously, if your money's in an IRA, then you don't get taxed until you take it out.
Right.
So if you're in the market in an IRA, You don't have to worry about it until you take the money out.
But boy, that would be some
But,
bad news.
Think about this. I know it would be a nice question for Mike and Glenn before us. What about, what is it going to do to the market if these millionaires start taking money out of the market because of the higher taxes? That's going to change a lot of different aspects of, yeah. I mean, but that's what
why
our
people
government's
vote.
doing. Yep.
So another change coming down the pike. This is proposed that estate taxes, once you exceed that 3.5 million, and like I was saying before the break, that's your home, your life insurance. If you own the life insurance policy, all your IRAs, all of your assets, your if you got a family farm, family business, it goes into there. And so and that's from the 11.7. So from 11.7 million, there wasn't too many people paying taxes. Now at 3.5, your estate taxes could have, they're talking about the rate moving from 40 to 45% up to 65% of your assets. That's a big thing.
And still, I'm sure a lot of people are out there going, oh, that doesn't really. And how many people are actually worth $3.5 million? How many of our clients, our elderly clients, your grandma and grandpa's out there, your parents are worth that much money because those people from about 80 and up never spent money.
Wow.
They say, right? But am I lying?
No. And then you know what, Chris, I love when you do this analogy. People often get confused with estate taxes. Do the, hey, I'm dead, or hi, what are the two taxes? Do them.
The estate tax we're talking about is the 706 that says, hey, government, I'm dead. This is how much I'm worth.
And then the other one
is,
hey, government, I'm dead.
But I'm still making money, and that's the Form 1041, which they're thinking of increasing.
And they're both called estate taxes.
Right.
Right. It's very confusing.
So that can be very confusing.
It's just
but
insane.
if you
then the other thing is the gift limitation. Everybody says, how much can I give without doing a gift tax return? Well, right now it's $15,000 per person per year, right? But they're proposing that be lowered to $10,000 per person per year. So that's a big change as well. So a lot of people that are trying to reduce their overall assets because of Medicaid, and they're trying to get that 5-year look back, they're trying to get rid of their assets. This makes it, it's a 50% reduction in what you can give.
Right. But, it's still, you can give as much as you want. I mean, if you're not worth
do a gift tax return.
Right. If you're not worth $3.5 million, it's not going to impact you.
Well, again, that's if that's passed.
If it's
okay,
passed.
so, but here's some things for sure, okay? For sure, what has taken place is the child tax credit. Now, there's a lot. I mean, if it has anything to do with the federal government right now doing it, it's just not good. So that rollout of the advanced child tax credit that you were supposed to get $300 if you had children under the age of 6, and from 6 under the age of 19, you get $3,000 or $250 a month. That was supposed to be going like a hot knife through butter. Not so. Right? This month, they said, oh, there's a big computer glitch, and we didn't put them in direct deposits. They're going to be a check mailed to you. So this puts it back on you, the taxpayer, to go back to the IRS to make sure you didn't move, because they won't forward it, that your correct information is on there, because they're supposed to go back to direct deposits again in September.
Right. Supposedly.
Yeah.
Hate to say that.
And they did, and we were very concerned about when it's tax time, because if you've gotten this advance, it reduces the credit you're going to get when you file your return. They did say they're going to send out a letter stating how much they paid you. Now, here's the weird thing. They may have paid you, but you moved, and that check bounced and went back to them.
Right.
They probably don't know if it cashed. And so that's something you have to be diligent and make sure that you're reporting what you actually received, not what they sent.
Right.
Just make sure that address is correct.
Right. We've had a lot of people who oh my God, I got this letter. They adjusted my refund. I don't understand why. And it's for the recovery rebate credit that, the person said I didn't get it, but they said the IRS says you did get it. So either A, you got to go back and check your records.
Right.
Or B, it's lost somewhere. You might have gotten the debit
And
card.
here's the really sad part. They're not answering the phone.
Right.
So it's, you say, wait a minute, you're wrong. I'd like to get to the bottom of this, but they're not talking to you.
Right.
So, hopefully as we move from COVID, but it sounds like it's all coming back again. It's interesting. A friend of mine's husband is in a memory care unit, and they all have had the shots. But 18 people just got crossover COVID.
Yep.
So, it's very interesting.
It's supposed to be
God knows what's going to happen down the pike.
To be a reduced case of it,
What,
if you have the vaccine, it's supposed to be
right. I
reduced.
guess nobody died,
Yeah.
But 18 people.
Yep. Correct.
So, and now I guess they're down to 2 right now. All right. I'm Esther Gillius, the tax lady, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930, and we have a text.
Yeah, we've got 2 texts. The first one says, I had a contractor borrow my truck in March. He promptly crashed it. It is totaled and can't be found. It is a 2003 Ford Ranger, so I had no collision and higher mileage for the 2003. Thanks in advance. How should I show this loss on my taxes, assuming I can do this? Judging from the cost of a replacement, I would have to pay $7,000 to $8,000 for a new vehicle.
Well, first of all, it has a lot to do with whether he was in business, right?
Right.
Because if he was in business and this was maybe one of his contractors working for him, and they said, hey, Jack, can I use your truck? I'm going running up to Lowe's. That's one thing. But if he wasn't in business and he just let Jack use it, explain the difference between the two.
Sure, because it was a business asset, depending what his cost basis was, he could write it off on his tax return against his gross income. So if it was as a business loss,
right?
Right. Compared to if it was just a personally owned vehicle, unfortunately, the casualty theft section is gone from your itemized deductions unless it was in a presidentially declared disaster area, which this has nothing to do with it. So there would be no deduction for him.
Except on the state of New York.
Correct.
Right?
Yep.
And the loss would have to exceed 10% of your adjusted gross income plus $100. So he said $7,000, I think, right? Wasn't that what it said, 7,000?
Yeah, it said 7,000 to 8,000.
Right. So let's say his income's 100,000. Well, before he even gets to taking anything, he has to reduce the loss by $10,000. So he'd have no deduction on New York State either. So hopefully this is a business loss.
Right. Yep. Definitely.
Cross your fingers.
Yes.
All right. What's the
Yes,
the
because
second text?
because if it's not a business loss, there's not even an option to take it on the federal, but maybe you can
But
on the state.
right.
Yeah, and so maybe you can on the state. And the second text is, if I understand correctly, you still are not filing corrected returns as a result of the $10,002 unemployment allowance. Am I correct?
That's correct. I mean, we right now are relying on the federal government, and they have been releasing funds, right, Chris? Tiff?
Yes.
Right. They've
been
been
releasing too much funds, but they've been releasing funds.
Yep. So gotta watch it and be careful with the money you get. Call us, let us double check to see if it's the right amount, and we'll let you know.
Right.
Yeah.
So
Yeah,
not only have they been sending the money, they're sending too much money.
And so, because, I've been doing this for a long time, and I've never seen the IRS.
Me too. I've been doing it for a very long time.
I've never seen, in essence, the IRS doing their own amended returns. And
well, they're really not. They're just taking out the $10,200 that people put in. Well, it isn't the taxpayers' fault. They changed the law in the middle of the year.
Right. But what an undertaking for them to do. I mean, they already had the child tax credit. They already had the stimulus. They already had COVID. They already have people working from home. And now we have them doing these adjustments. I mean, they're just...
And the advanced child tax credit, right?
Yeah, it's just...
So, and 3 stimuluses, so it's unbelievable. I will say this, if you haven't gotten the stimulus yet, it'll become a recovery rebate on your 2021 tax return. So that's another thing coming up. So, well, I'm Esther Golias, the tax lady, 803-0930, 803-0930, star 930 on a cell phone. You can text us at 716-803-0930. We're going to take a short break, and we'll be back on the other side.
All through the night, we made love underneath the stars above. So before you go thinking over, please, you never
So that's
know
Fatima Santini singing for us. And again, if you're interested in getting her music, I guess you can go to her website at Fatima Santini. So Fatima Negron Santini. You got to feel sorry for her. She lives in Hawaii, right?
Oh, yes. Very sorry.
Hawaii is a beautiful place.
Oh, my God. It's absolutely gorgeous.
It really is. I mean, they did good when they bought that island, them island. Okay, let's go back to some of the things we want to talk about. Remember this year, you have to take your required minimum distribution. That 1 year, because of COVID, they let you blow it off. This year, you got to take your RMD. If you don't take it, the penalty's 50% of what you didn't take.
Right, and you really want to plan accordingly. There's lots of people that are seniors that didn't have to take their RMD, and so less of their Social Security was taxable, and so you really want to plan for it. On the second note of that, the flip side, there's a lot of people that call our office and they can take money out of their IRA or their 401k tax free because they're under the filing
That's
threshold.
exactly right.
So
There's a lot of
just-
people that, a lot of people say, oh, I just want to do the Roth because when I take it out, it won't be taxable. But the truth is your standard deduction's so high, you don't pay taxes anyway, and you can probably take a lot of money out of your IRA tax-free, and you got the benefit of having a traditional IRA and deducting it up front. So that's something you need to tax plan about, right?
Right. Yep.
Okay, why
Definitely.
don't we go to the phones and we'll talk to Kenny. Hi, Kenny.
Oh, it sounds like you're in a windstorm.
Hello, Ken.
Hi, how are you?
Good. What's new?
Not a lot. My daughter, at the initial tax season, she took the tax credit and gave it to her estranged boyfriend, correct? So now that they changed the law, he's getting that $3,000 or whatever a month.
That's right.
She's not.
I know.
Is there any way for her to change that or fix
Okay, so that's what's going to happen this year. There's going to be a lot of corrections because there was no to many people looking at old tax law. They said, well, I'm not going to get anything. I might not be working, and so I'm going to give this to the baby's father, right? And so now with the change, she's going to have to reconcile that on her 2021 tax return, and then the money that he's gotten, he's going to have to pay back.
Oh, beautiful. I love you.
So it's going to be interesting to watch them reconcile these two things because it's going to be pretty prevalent as far as I can see. And one of the changes that I'm just going to talk about is that mommies that didn't work before because maybe they were at home with the kids and didn't have any income, and there was no reason to claim the child. Now they will get the child tax credit and they don't have to work. So that's a lot of money. So if they had 2 kids under the age of 6, that's a lot of money.
So it'll be a pot of gold at the end of that rainbow for that lady finally. And
$7,200 for her.
Yeah.
So, but Daddy then would have to pay it back. I would suggest she say to him, Ken, that she goes in and he goes into his account at the IRS and stops receiving the money because if he doesn't claim those kids on his tax return this year, because it sounds like she's going to because they live with mommy, right?
Well,
then in that case he'll have to pay it back. So he should stop getting that refund, the advanced child tax credit right now.
Well, he told her it's too bad. And he's not even.
What, no, I mean, if those kids live with her, do they all live together?
No.
Okay, so if those children live with her, she's the person that has the right to claim them. Okay, so she should let him know, I'm claiming them, I'm getting the money, and so stop the advanced child tax credit because he will be very sad during tax time.
That's okay.
And she has the health insurance is under her address, and any education or anything, the doctors would be all under
She
her
can prove
address.
that the kids live with her, right?
Oh, absolutely.
Yeah.
And then
So-
and then after this, going forward, she'll get the advanced child tax credit if she doesn't decide to get it at the end. So this will
Yeah, well,
fix
she'll get it in 2021. If he got the advanced child tax credit monthly, is going to have to pay it back.
Right.
Okay? Okay. I'm Esther Gullius, the tax lady, 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. Okay, and with the RMD that we were just talking about, people that are over the age of 72 taking the required minimum distribution can use the charitable rollover to mitigate the taxability of this RMD, right?
Right. Have the money go directly from the IRA to the charity, and you can then, it does not count as income on your tax return. You don't get it as a charity write-off, but that's okay because itemized deductions are so high, or not, your standard deduction is so high, it may not impact it as much as not putting it on page
Okay,
one
and
of
then
the
this year, now last year, the charitable deduction adjustment was $300. And next year, the charitable deduction is going to be up to $600 on a married filing joint return. So that's another change. And then the earned income credit, it now goes up to income. I can remember, I swear to God, I think it used to be like $22,000. Wasn't it something like that, maximum?
Yeah, I remember 30.
Now it's $56,844 if you have 3 children or more. And the credit
That's
is
huge.
$6,660. And what's really cool is now seniors who were working that are over the age of 65 in the past couldn't take the earned income credit, but now they can. So, but you need earned income.
Right.
You do.
So they should go get a job.
We got the fourth quarter knocking on our door, so go get a job. And everybody's hiring, so that will make
That's
it that
right.
much easier.
That's right. And so if you don't have children and you don't have children, you can have the earned income credit as your with income up to $15,840, and the earned income credit would be $538. So you make a little bit of money at Walmart or whatever, and part-time job for Christmas, and you get the earned income credit. So that's pretty cool.
Definitely. Yep.
Right?
And the night, and yeah, like you said, it bears repeating. It's so wonderful that seniors get it, and I've got so many seniors that are on disability, and so it was when it turned 65 that money stopped for them, but now it's open for them, so it's a great thing.
Right.
Yep.
And the other thing is the phase out for the child tax credit, and I believe the advanced child tax credit is $75,000 if you're single, $150,000 if you're filing a joint return. Otherwise, it reverts back to the old child tax credit, right?
Yep.
On income up to $400,000, but then the credit would only be $2,000, not the $3,000 and $3,600. So if your income is hovering around that number, 75 if you're single, 150 if you're filing a joint return, make sure you don't go over that figure if you can help it. And one of the ways you'd help it is putting more money away in your pension plan.
Right. By lowering your income.
Right. But again, if you don't look at it till January, it's too late.
Yeah, you gotta plan and make those contingency plans and put money into your HSA and your flex spending. And there's also at work, there's for child and dependent care money, setting money aside for that. But you might not want to do that this year because the child and dependent care credit's up to 50%, which is just amazing.
Now, do you know if this is the same? Is this phase out also in the child care credit?
I have not seen phase outs for that.
Yeah, because I'm wondering if that's part of the juice and the child tax, child and the daycare credit. So now the daycare credit is now 50%, and you can get a credit up to $8,000 for 2 or more children. So, and again, that's another gigantic change. So you want to make sure that, and again, you know how it used to be that floating rate up to 20%, right?
Right.
So
Yep.
I don't know how that's all going
Yeah,
to work, because
and-
until the law comes out, we don't know yet.
One of my clients just got a letter the other day, and so New York State disallowed her child independent care credit because she paid with cash. So just a word out there for everybody, anybody who's listening. If you pay with cash, there's really no way to trace it and track it, and it's not provable. So make sure you're using checks or credit cards to pay for.
Even checks, the state of New York can give you a hard time with.
Yeah.
You know, so you want to make sure, that's one good thing about if you're using a professional, and I use the word in quotes, daycare provider. In other words, it's not your Aunt Millie. It's actually little cherubs or something, who then has a corporate return, and they're collecting the income, and they have an EIN number. But if you're doing it with Aunt Millie, you want to make sure that you can document it, because they will disallow it. And the only way you win is to appeal it, and then that becomes costly.
Yeah, from a personal standpoint, Chris and I have been audited before by New York State, and the charity statement from a church wasn't good enough for New York State, and so we had to give them every canceled check, and so New York State can do what they want to do.
Right, and your only alternative is to protest and go to appeals. So, and then it becomes very frustrating. Okay, and then finally, this year, the kids that were filing on their own last year because of unemployment and because of the stimulus, probably this year, your older children in college, you're going to want to revisit claiming them because of the American Opportunity Tax Credit.
Yeah.
Right?
Yeah. That's going to be one less thing that I have to think about, but there'll be 20 million other things to think about. So lots of parents didn't claim their kids, lots of my parents, because they got all that back stimulus. But this year, don't have the kids rush out and claim.
Don't assume, because what happened last year because of all that COVID stuff, that's another era. So we want to close the book on that. But what we want to do now is go back to what makes sense. And so we're trying to get you so that you guys know what's in your best interest, because we sure don't want you to overpay, right?
That's right.
All right, so during the week, if you're getting love letters, you're getting too much money from the IRS, you can't believe it, and you need us to double check to make sure that you set aside X amount of dollars until they write you back. You're interested in going to our tax school, got tax questions, you can go to our website at egtax.com, ask the tax lady. You can call us at 632-7886. And that's it until next week. I'm Esther
Go
Gillies, the tax
Bills.
lady, with Tiffany Fabian and Chris Fabian. And thanks for listening. And by the way, listen to our podcast.